James Athey, investment director de Abrdn. James, good morning.
Hi, good morning.
What is the risk of stagflation in this moment?
I'm afraid it's uncomfortably high. We really do have already, I think, in place conditions which could very easily lead to stagflation, not just in Europe, but elsewhere. But I do think the risks in Europe are probably higher than everywhere else. Essentially, stagflation was a term coined to describe high inflation at a period of high unemployment. And we know that continental Europe has had higher than hoped unemployment throughout really the last 10 or 20 years. And now we have such a huge shock coming from higher prices. The potential for that to drive growth lower and unemployment even higher, I think, is very real.
Bullard, Federal Reserve, says yesterday that 75 basis points need to be raised in the next meeting. Can we go into an economic recession?
Yeah, I think we can. I mean, essentially what central banks are having to try and do is hurt demand. Their tool, monetary policy as a tool, is very blunt. It cannot be surgical. It cannot be precise. It can merely attempt to influence demand higher or lower. The reality is that most of the inflation that we are seeing has come from global factors and from supply side factors. Firstly, the pandemic, and secondly, the military escalation between Russia and Ukraine. These are not things that central banks can deal directly with. What they are attempting to do is deal with the potential second round effects, and that is to say the psychology. They don't want consumers and workers and companies, employers, to become accustomed to high levels of inflation and start to behave as if those high levels of inflation will persist, because that becomes a self-fulfilling prophecy. The only way central bankers can try and influence these second round effects is to lower demand with tighter monetary policy. And of course, doing so is very imprecise, and therefore consumers who are already struggling, the cost of things we must consume, that is to say food, energy, fuel, these things we cannot avoid consuming, and their prices have increased dramatically, meaning we have less to spend on desirable, discretionary consumption. And now we have central banks who are likely to try and lower demand even further. Therefore, the risks of going too far, pushing economies into recession, I think, are very, very real.
What alternative do Bancos Centrales, central banks have?
Sorry, can you repeat the question, please?
Yes, what alternative do central banks in this situation?
Unfortunately, they don't have much of an alternative. In prior episodes of incredibly high inflation like this, central bank mandates were much looser, much less precise. Central banks weren't in the public eye to the same degree. And actually that allowed central banks to implement policy which wasn't appropriate and caused the inflation problem to get worse over a number of years. Today, all central banks have some form of inflation targeting mandate, and therefore, in most cases, they are legally bound to attempt to deal with high and rising inflation. And so this is a very uncomfortable position for central banks to be in, and each central bank is reacting slightly differently. But the reality is that zero rates or even negative interest rates at a time where inflation is 5, 6, 7% or higher is just completely inappropriate. And central banks know this, and their options therefore are just about how quickly they remove stimulus, not whether they remove stimulus.
What options does the investor in this context of stagflation?
It's a very difficult environment to be an investor. It didn't really happen globally in 2018. Only really the Federal Reserve in the US was tightening policy. But what we saw was that the price of all financial assets fell. Government bonds, which are often a hedge for equities and other risky assets, the price of government bonds was falling at the same time that the price of risky assets was falling. And that's really a phenomenon that we see in front of us today. So the usual portfolio of a mix between equities and bonds, we would not expect to perform well in an environment of high rising inflation and tightening monetary policy. So I do think cash should be a significant proportion of a well-balanced portfolio. And to be honest, I think precious metals are still, even having had a pretty solid price performance recently, particularly because commodity markets in general are being supported by supply disruption, and precious metals have historically been inflation hedges. I do think also they are an attractive component of a diversified portfolio. But for most investors, I think this is going to be an uncomfortable period that one should try and ride out without panicking, without over trading, and looking through to the long term, where I do expect central banks ultimately to regain control of the inflation narrative.
Thank you very much, James Athey, investment director at Abrdn. Good day, good business.
Thank you, you too.